Hello, everybody. We're just waiting for a couple things to work their way through here. So we are going live on Facebook group, on YouTube, and those of you who follow the Northshire Consulting individual page on Facebook. Give it a couple seconds. I know it takes a little bit to filter through here. But for those of you who don't know, my name is Brian Williams. I'm from Northshire Consulting, which is an independent investment advisory firm in Southington, Connecticut, about the middle part of the state. So like I said, we're broadcasting to 3 different segments. This is our YouTube channel, which is 401k and beyond. Also our Facebook group, 401k and beyond, and the Northshire Consulting individual page. So why this fund? Why today? Why are we here? So early April 401, we decided to start a Facebook group and really sort of grow that out. So we've got well over 400 members now, and working through some different themes and some different projects, we ended up with Mutual Fund Monday. So what we do there is on Tuesdays, we put together a poll and we pick a particular category to look at. So we've looked at intermediate bonds, we've looked at large cap funds, we've looked at international funds as well, I believe. And now we're on to small cap funds. So what we decided to do is just take this video, one that I normally just kind of do on my own, and put it together and post it to various places, and to put that out live and just kind of let people see how the sausage is made, if you will, and potentially ask some questions if they want to do that along the way. But we figured this is something we're doing anyway, putting this video together, so we might as well put it together, I guess you would say. So we do that poll inside of the Facebook group. So if you're watching this on YouTube or just follow the Northshire Consulting page, you can join that group. That group will give you access to allow you to vote for which funds get reviewed every week. What we're doing now is the other 9 funds that don't win in the poll, we do little short videos, just mainly focus on some of the data and where you would use those funds. Little 2 or 3 minute videos, and we post those on YouTube. That way, this fund this week won by a narrow margin. So all those folks who voted for the second place fund, they still have something they can go out and take a look at. And then, potentially as time goes on, we'll go back and review those funds. We may also do some fund side-by-side comparisons. We had some requests for some target date fund side-by-side comparisons. Maybe you can get the TSP in the mix too. But potentially looking at Vanguard versus T. Rowe versus American Funds target date fund. So we've got a few ideas for this mutual fund Monday live session, and we'll see how this goes. Maybe we'll go live once a month and continue the other 3 or 4 weeks doing just the regular posted videos. So this fund, we're doing a Vanguard Explorer, which is a small cap growth fund. So this is a good fund. I'm excited to do this one live for a few reasons. We have, first of all, it's kind of an interesting fund in the way that it's structured. Small cap doesn't get as much headlines or the press, obviously, as large cap, and everybody's pushing money towards index funds, which is great. But on the small cap side, sometimes doesn't get as much love as some of the mid and larger cap friends. Also, I have my friends here. This was a gift from Vanguard, some of my friends over there. In no way influences any of my investment dollars, but this came to me shortly after my son was born 3 years ago. So this is my Vanguard bear. So this is reminding you, if you're watching, to bear with me as I stream my first live here. But that's my buddy, so he's going to be joining me on the show today, hopefully giving some thoughtful insight. So this is a small cap growth fund put together by Vanguard, and really what it is a fund of funds. So I know what you hear, sometimes when people hear that, they say, okay, well, this is probably just a high expense fund, without taking the Vanguard piece out of it. But it's a fund of fund. It's just a manager that selects other managers, that adds to the fees. And normally, sometimes that can be the case, right? But in the small cap and in the mid cap arena, what happens sometimes is these funds get so large, they have to bring in outside managers and essentially give them a sleeve. So that's what we have here. We have 5 different managers, and we'll talk about who they are later on, but 5 different management sleeves that make up this Vanguard fund. So you have Wellington, which has had a relationship with Vanguard for a long time, that makes up about 35% of the portfolio. So they're running that, small cap or really mid cap, sleeve. And then you have 3 other groups that are running between 15 and 18% of the fund to make up that total fund. So when we talk about active management and manager selection, you're not really picking one manager, you're picking Vanguard to pick which managers are running a sleeve, and then how they allocate that money, right? So if they had 5 managers, obviously they could give them all 20%, but they're really showing their commitment to Wellington by bringing them into the mix and giving them the lion's share of the assets. So this fund, we're going to get into some slides here and talk about that a little bit. Share my screen here. So the reason this fund was selected, this fund is not, we're not giving any specific investment advice or saying this is, the world's greatest fund, and that's the reason we're leading off with this. We're just at a point in time where we were picking the small cap fund, and this is the fund that won the popular vote, if you will, in the group. So that's why we're here. This is not specific investment advice, not specific tax or legal advice, but we're just telling you that this fund is the winner of the votes this week, and so that's where we are. So you've got a ticker here, VEXPX. You do have a couple different share classes available here, but all the numbers through this presentation are based on the investor share class, which is the VEXPX. You do have the Admiral share class available in there as well. So you do have a couple different ways to purchase this. The Admiral share class comes in at 30 basis points, whereas VEXPX, the investor shares, is 41 basis points. So that's 0.41%. To get into the Admiral share class, you do have to meet the minimums, which is $50,000. For the more expensive share class, 41 basis points, you just need that $3,000. So, but for the purpose of this exercise, we're going to look at VEXPX, and all the numbers are based on that. What's interesting about this fund is some places you'll see it listed as small growth, which is the Morningstar category. But when you look at the style box, it's showing up as a mid-cap growth. And that goes back to the prospectus and the benchmark. So even Vanguard isn't saying this is specifically a pure small cap growth or specifically a pure mid-cap growth. They're calling it a SMID growth, and they're following an index that really is a SMID growth index. So what that means is this fund is going to invest in stocks that are on the smaller side. So large cap growth, that's easy. That's Google, that's Amazon, that's Microsoft. We know all those names. This is going down in size, going to some of those companies that fly under the radar a little bit. So, not your household names, might be some things you recognize, but not your typical large cap companies. So, so this fund, if you look at, it doesn't fit purely in one of these style boxes. So when we look at how this fund is used, sometimes this isn't a fund that you'll see a lot inside 401k plans. Usually 401k plan lineups are really, they follow the style boxes. They don't use a lot of funds that can move around from style box to style box, or kind of bridge a style box like this one does. That doesn't necessarily mean it's not a good fund, but you're more likely to see this fund being used by advisors in in an IRA or in an outside account that's not part of a set investment lineup. Reminder again, nothing in here is specific investment advice, purely educational, no tax, legal, or investment advice. We're an independent advisory firm, no affiliation with the fund reviewed. Just happens to be, where we are in the cycle with the group and the YouTube channel, and we may or may not have assets in this fund. So this fund has been around a long time. It's got $24 billion in it, a little over 700 holdings. So, to put those numbers in perspective, when you're looking at the holdings, having 700 holdings means it's obviously well diversified, but you'll see funds that are very focused in the small cap space, even in the large cap. They might only have, 25, 30 different stocks in them. So a lot of you folks are familiar with the S&P 500, right? You see how that's reported in the newspaper or on the news, and that's basically the 500 largest companies in the US. So this fund is more broad than that, and it's going down the spectrum in size. And this fund is actively managed. So I know a lot of times with Vanguard, we think of, low cost and indexing, and that they don't believe in active management. And that's actually not really the case. They've got a strong history in active management. They just believe it active at the right price. So you won't see Vanguard actively managed funds costing 2% or 2.5%. You're not going to see that. What you're going to see is active at the right price. So you're going to see a lot of funds in that 40, 50, 60 basis point range, saying that it's tough for a manager to really outperform by 1% to justify their fee. At that point, you're better off going with an index. But as that fund gets cheaper, as the fund gets less expensive, it's a lower hurdle for that manager to get over. So, when we look at the management of this fund, that information matters, but it really matters more about the sub-advisors underneath and how that's made up, because you don't have one particular manager here, one particular individual or a team picking out all the stocks in this fund. So this is a pure, U.S. equity fund. You're not going to see a lot of international stocks in here. You're not going to see a lot of bonds, and they don't have a heavy weighting to cash, right? So this isn't a fund that's making market calls, meaning they're not going to sell a bunch of their U.S. equities and see a cash position of 20 or 30%. That's not what this fund is designed to do. This fund is designed to get you invested and keep you invested in that small to mid cap area. So, we talk about some of the names that they own. They're not the large cap funds, but a lot of these names are ones that folks will be familiar with. So some names that'll jump out at you, Burlington stores you see around, and Skechers. But even so, the top 10 holdings, even the largest holding there is barely over 1%. So each individual stock here is not going to have a major effect on the performance of this fund. And remember, you're getting, Burlington is in there as the number one holding based on 5 different sleeves of this fund in the aggregate. So they all might own a little bit of Burlington, or maybe it's just one sleeve that owns a heavy slug in Burlington. So we don't know how this fund is, where that particular slice of Burlington is coming from, but it's important that you know that it's not just one manager picking out that individual stock. So like we said, Vanguard believes it active at the right price. There are 41 basis points on the share class, which translates to $4.10 for every $1,000 you have invested. The small cap category average is almost 1%, almost $10 for every $1,000 you have invested. So this fund, obviously costs considerably less than that. Small cap funds in general are going to be more expensive than their large cap counterparts or even their mid cap counterparts. And the idea is that it costs more because the research has to be a little bit more extensive, and it's harder to research a really small company than it is a really large company. Obviously, there's a tremendous amount of information out there on Amazon and Facebook and Google and all that sort of stuff. Whereas Burlington, maybe there's not so much information out there. So the expectation is that the fund is going to cost more to run, and ultimately that gets passed on to you as the investor, right? It comes out of your returns. So when we look at that fee and we say, okay, how is that fee being justified, right? If we were paying a fee of 40 basis points or more, in another fund, and they weren't beating their category or beating their benchmark, you'd say, well, why are we paying that extra fee? We might as well just buy the index fund. But this is a situation where when you're comparing them to that small cap growth category, yeah, they've outperformed most of their peers, in 8 of the last 10 years. So you see that they follow the category pretty closely. If you look at, 2017, they were up 22.95, whereas the category was up 22.92. So just a little bit of a win for them, but they do follow this category pretty closely, even though they do have a large slug of their portfolio in that next box up, in that mid cap category, So 8 out of the last 10 years beating their category. Against the index, similar, but but not as many wins for the fund, right? So they're comparing to that Russell 2500 growth total return index. And they beat that index 6 out of the last 10 years. Russell 2500 is an index that you don't hear a lot of, even from, Russell. You hear less of Russell than you do, obviously, the S&P or Dow as far as index providers, or even MSCI. But you think of Russell as the Russell 3000, which is basically the whole stock market, and then the Russell 2000, which is a pretty common small cap benchmark. And this is, like we said, sort of that mid category, small mid. So they're taking that Russell 3000 and then pulling off the top 500 companies and doing the next 25. So it's the total stock market without the biggest 500 companies. You could look at it that way. So that's the benchmark that they've said that they're going to compare themselves against. Overall, I give this fund a B+. It's a really good fund. You're going to see this fund, like I said, a little bit more on the IRA side or a little bit more on the individual side. Vanguard's, a great company. We know they've been around a while. They do very good work on the index side. The risk of this fund, is that it can kind of move around in that category a little bit. So you want to make sure how you're building your portfolio. It's kind of a tricky fund to build around, which sort of affects the risk category. You could use this fund to take up that whole, take up both of those boxes in your portfolio. But if you do that, you might end up with a little more weighting in this fund than you would like. So that's why I knock it down a little bit on the B side there. Some other things you want to take a look at as far as the fund returns go, and I'm going to stop the sharing here for a second. Obviously Morningstar.com is a great resource. You can always go on there and pull off a lot of information and learn a lot about funds. They have some additional premium services that you can subscribe to. And then of course, Vanguard.com is another great website you can use to just pull out information straight from the source. A couple things that I just noticed flipping through my notes here on this fund. When you look at Vanguard as a whole, they've got almost 5 trillion in assets. So, it's a group that's really grown a lot as investors have become more fee conscious. So a lot of money has flowed into their target date funds. A lot of money has flowed into their index funds. So really, they are one of the true behemoths in the mutual fund market. So, Vanguard is one of those fund families that you can rely on. They're going to continue to work hard and lower their fees and their expense ratios. Every once in a while, you see it tick down by a basis point or so. So getting back to when we started talking about this fund early on, we said it was a fund to fund, right? So it's got different sleeves in it. So normally that can make a fund a little bit more expensive. But in this scenario, it really doesn't, because they have such large purchasing power as Vanguard. Again, maybe it says lots of brand loyalty. Yeah, people really do. They love Vanguard. They love the fact that, the whole, Bogle story and how he started it and in indexing for less. So you got a lot of loyal people, and across the knowledge spectrum, true, which is kind of interesting. So you'll have what we call less sophisticated investors, probably isn't the right word, but sometimes you'll be at a 401k meeting and you'll have participants out there, and there's always somebody who raised their hands and said, I just want to do Vanguard funds because I'm 22 and that's what my parents said. So do you have these in the lineup? So they do have that sort of brand loyalty and brand recognition that's almost inherited or passed down from generation to generation. So it's never a bad idea to have some Vanguard funds in your investment lineup. That's for sure. We want to take a look at the sort of the deeper dive into some of who those managers are that are putting this fund together, because they're not all Vanguard employees. This fund is not totally run by Vanguard, so to speak. They do have sub advisors. So we talked about Wellington, which has got a really long relationship with Vanguard and has run some other funds for them. These sub advisors, they're not anything that's set in stone. They've changed these these managers around, a good fair amount. They're not, trading them quarter to quarter, but they have made changes. They have made changes. They've pulled sub-advisors out. They've pulled, reallocated different. So, 6 teams were added, and between 2008 and 2017. And subsequently others were removed. So there is some turnover there. So you are getting some active management of the sub-advisors there. So you've also got ClearBridge, which joined most recently in March of 2017. You've got who the other groups in here? Scrolling through my notes here. Lost them here for a second, but ClearBridge is another group that they're known for sort of that small to mid cap area, and they're running this sleeve independently of what the others are doing, right? So that's an important thing to note. It's not like Wellington is talking to ClearBridge, or they're working together in any way. They're if anything, they're sort of competing against each other to get a bigger slug of this fund, right? So those managers that are in there at 17 or 18% of this fund, they're trying to get some more share of this fund because it is such a huge fund, right? We talked about $24 billion in this fund. So they're trying to grow their position in this fund. There was a time when this fund was, 700 equities in this isn't by any stretch concentrated, but there was a time when this was a lot less concentrated. They did at one time have 14 or 1,500 different stocks in there. So that might have been one of the reasons that they skinnied it down a little bit from an equity standpoint and the number of equity holdings, because when you spread yourself that thin, it's hard for each of those individual positions to really have any sort of impact on the portfolio. So I do want to close up with, kind of where you'd want to use this fund in your portfolio. Like I said, you don't see it a lot in 401k lineups. It's probably a better fund that you'll see maybe more in is part of an investment model. So if you have a 401k plan where there's some models or some advisor-led target date retirement funds or birth year funds or something like that, you might see that fund in there because it takes a little bit of nuance to build around it. If you have this fund in there, it's not necessarily a pure mid cap growth or pure small cap growth. You may want to fill in around with some complementary managers, but there's never any one mutual fund that should be 100% of your portfolio, even though Vanguard's got some great total stock market. Another Facebook user said it's possible to be too diverse. Yeah, I mean, and this fund narrowed its focus a little bit on the equity side. This is a fund that can that's a good point too about the number of holdings that you have in your. You might have an IRA that you opened, and you might have $5,000 or $6,000 in it. And, once you get through all the 9 style boxes, once you get through international, I mean, you might end up with 20 different funds in there, and that's okay if you're comfortable with that. But sometimes you might want to look for something like a SMID fund. You might want to look for something, its counterpart, where you say, for now, while my balance is maybe a little bit smaller, before I put in next year's contribution or whatever, I'm just going to take this fund and this is going to cover 2 style boxes for me. So that way it's one less fund I have to keep track of. And because it's Vanguard and because I can, sort of trust them to play well in that space, this might be a good spot for me. You could also use this fund if, let's say you had a 401k plan that was, even some of the bigger plans you'll see don't really have a broad investment lineup. And a lot of times they're very large cap heavy. So let's say you had a really good, maybe a total market fund in your 401k plan. And then in your IRA, you said, well, I want to get a little more small, a little more growthy. So I'm going to use this fund in there. So you got your big 401k plan, and then you've got maybe your smaller IRA out here that you've been contributing for. So maybe this is a fund that you could use in there to sort of balance things out a little bit. So that's a spot when you'd want to use this fund. I think that's probably about all that I have here. The expense ratio we talked about is very good against its category. The performance is very good. Vanguard as a whole. I mean, you can buy this fund directly at Vanguard. You can buy this fund like anything else. You can buy it through, Schwab or TD or wherever else your custody. A lot of times with the Vanguard funds, there's an additional ticket charge on those. So you want to make sure that's right for you too. If you've got to pay a $50 ticket charge, you don't want to put $500 into this fund. So, but typically if you're buying them through Vanguard, that's okay. So you don't have to worry about that too much. Are there any other questions on anything as we kind of closed off here? We had half an hour blocked out, so I want to make sure I leave a few minutes here for questions. But if you're watching this live, or if you end up watching this on a replay or watching this through YouTube, if you're watching it on YouTube, you might want to join that Facebook group. That way you'll have a say in what funds get the long review. If you're watching this on Facebook, you might want to check out the YouTube channel and subscribe to that too, because we do those smaller, the shorts we call them. We do the survey, and then the other funds that don't win the survey, we do shorts on those and put them in the YouTube. So we're gonna, be doing a lot more videos, but we'll post most of them to the YouTube side so we don't fill up that Facebook group too much with all the videos. But if you have a particular category, or if you have a particular fund you want to see reviewed, you can reach out to me. It's probably on the list anyway. But typically we put the surveys together with just the 10 largest funds from that category. And right now we're not specifying between growth and value. So when we say small cap, we're just picking the 10 largest small cap funds. And even though it's more of a retirement plan or 401k specific group, it's just the assets overall. We're not just focusing on funds that would be inside the 401k plan. So thanks everybody who watched this live, and we'll see you probably again when we do this in a month or so. Thanks.